Hello, everyone, and welcome to Inderes TV. Many of you have asked for a CEO interview with the ad tech company Verve, which we cover here at Inderes. So I have been collecting a wide range of your questions, and today we will walk through them together with the CEO to reflect on 2025 and get a clear view of where the company stands today and also discuss the road ahead. And with that, I'm pleased to welcome Remco Westermann to Inderes TV. Welcome.
Hi, Christopher, and thank you for having me.
Thank you, Remco. And as mentioned, we will be addressing several of the key topics that are on investors' mind and moving through them one by one. So with that, shall we begin?
Perfect.
All right, so the first topic for this interview is the platform unification. And clearly that has been some sort of topic this year, and it has had a negative impact on your operation and short term, and especially Q2, but also in Q3 to some extent. And while you have talked about the platform unification and what actually went wrong in the CMD, in the Q2 report, and in other channels, where you talked about issues with load balancers, bidding interruptions, and also some customer delays in the onboarding. But many investors are sort of worrying about the customer impact following the platform unification. So on that topic, I guess some of your customers must have expressed some sort of concerns about the reliability of the platform, right?
Correct. Let me start maybe with, it's a bit repetitive, but we have a business model which works with organic growth and also M&A. And we have learned when we started with M&A, which is in the gaming part actually, that if you do M&A, you cannot leave the company standalone because it's gonna be unmanageable at a certain point. So if you buy companies, you need to integrate the technology, you need to integrate the teams. We've done many of them, and nobody has noticed that it happened because there were no issues with it. We have integrated 5 SSPs, supply side platforms, which is, let's say, the core of serving the ads, into 2. And those 2 were integrated now in Q2 and Q3 this year. What we didn't foresee, and that's also the reason that we changed our guidance, for example, is that we would have so many issues with that. The integrations before went almost without problems, at least not things that were really noticeable on the revenue. But this integration was really a very big one and indeed hurt a lot. To your question, customers were, of course, also not happy with that. The good thing in our sector is that the customer is never depending on only one platform. So they all had the possibility of also doing traffic over other platforms, via other platforms, which means that they didn't get out of business or did have huge impacts and things like that, which would also have been a risk, of course, for us. The very good thing actually is that those customers are also coming back with their volumes, which shows that we really have a very performant platform, even more performant now after the integration. And that's a nice thing. And you see it also on the numbers, of course. Our retention rate, 98% in Q2, 96% in Q3. So we have a very high retention rate. And with the customers being able to switch volumes away if there's an issue, they were able to not be impacted a lot, but they're also coming back to us because in the end, our platform delivers really good results. So I hope that answers the question. And maybe to also say that we had still issues in Q3 with the unification. And that's then at a certain point the platform runs, but you still have discrepancies on reporting and those kind of things. People are used to other reporting tools, things, because they also, the volume that you switched went to the other platform. And then it's never 100% the same, of course, to what they are used to. But those things were also towards end of Q3 over, with 1 or 2 maybe moving into even Q4. But the good thing is that we now see that with those things over, the volumes are back. People are increasing their volumes, and we also see that the platform performs much better for the transfer part than the other one did. So altogether, now I'm happy about it. I was not, I can tell you, and the team was also not, and also our shareholders not, and our clients not in Q2 and Q3.
And what kind of feedback are you getting from your customers post the platform unification? Are they noticing any performance improvements themselves, or is this solely something that you experience through better efficiency, lower cost, etc.?
Now, we see, let's say, we have, of course, direct contact with a lot of our customers, not with all, because it's a platform business where, let's say, people don't are in always in a regular contact. No, customers are happy with it. There's still some things where customers say, okay, this is what we're missing from the old platform, talking about the migrated volume. So we're still, with our engineering team working and product teams, working on getting those things in place. So there's further room for improvement. But overall, customers are happy with it. Volumes are back, and people are really increasing volumes. So yeah, overall, very high, I'd say, happiness. But of course, always things to improve. It's a big company, and we have a lot of customers. So it's never that all customers are happy. But you see it on the retention rate. It's really good.
Yeah. And you just mentioned the retention rate, and you have also talked about customers temporarily dropping below the 100K benchmark or level that you have. But investors are wondering about the actual churn. So how many customers actually left Verve entirely as a direct result of the platform unification or problems?
Yeah, we always have some churn, some customers leaving. There's also some customers that are not doing advertising every quarter. So also that is an effect, of course, that you have. But I would say it's very minimal. And the effect of the migration was really big in those 2 quarters because of people spending less, but very low on customers leaving us.
All right. And lastly, on the platform unification, is the onboarding trend now back on track, or have you witnessed any slowdowns in bringing new customer post unification?
Yeah, I have to be a bit careful, of course, because we are in Q4 and quite far in, and we haven't brought out any official numbers or any further updates, except for when we presented the numbers of Q3. But there, let's say, what I announced then, the company is really into a very good Q4. And yeah, onboarding is back. Customers are being onboarded again. And we had, of course, a bit of a backlog there. So that also helps about faster onboarding. So no, super happy and looking forward to present our Q4 numbers.
And then we go to the next topic, and that is the communication and forecasting this year. So there is some sort of frustration among the investors about the forecasting and the communication this year. And if we sort of go back in time, so in Q1, everything seemed on track. You were reiterating the guidance, and there were no clear warnings. And then suddenly in mid-August, you cut the EBITDA guidance by 20%. And investors are trying to understand the timing of this shift, basically. So when exactly did the company realize the problems were severe enough to impact the full year numbers?
We realized that shortly before when we, let's say, revised our guidance, which was on the 14th of August. If we would have realized that it would have such a severe impact earlier, we would, of course, have gone out earlier with a revision. The issue is, of course, you have a certain range for guidance. And as a company, you, of course, want to be into this guidance. If you're not, and if you're really certain that you're not, then you have to revise it. We were extremely long certain that even though we knew we had problems and even though there was issues with the platform, that we would still be in the guidance. And shortly before the 14th of August, we came to the conclusion that that's most likely not going to happen. That's the reason that we revised the guidance. It's never perfect. And in this case, let's say we had the platform unification issues, which dragged much longer, which were much more severe than we expected. And it's also not a super strong market. I mean, if the other side, the demand side, would have it could have healed a lot of that, but also that turned out at that time to not be that super strong. So in that sense, we had to do that. I mean, that's always a very difficult decision, of course, for a management, for a board. And we are, yeah, on this, of course. And if you don't need to, you don't change it. But at that time, we came to the conclusion that we had to change it.
And obviously, it's very difficult to sort of assess the impact when you're doing this sort of technologically integrations. but clearly there has been some underestimation from the company about the impacts on the platform unification. So what would you like to say to investors that are still questioning whether the problems are truly behind you now?
Yeah, I mean, it's difficult. Technical migrations are difficult. I mean, everybody who has a company knows that if you implement a SaaS system or something, it can always lead to problems. We were maybe a bit too optimistic because we had done a lot of migrations before, which didn't show these kind of things. So in that sense, yeah, you get confronted with it at a certain point, and it's not as predictable as it would like it to be. But what I can say is that the platform is running extremely nicely now. And as mentioned before, there's still some things on reporting where we can do, where some customers would like to see some other things. But the platform itself is more efficient, or let's say the volume that we migrated is much more efficient than on the previous platform. And it's also becoming much more efficient for us as a company. We did, let's say you don't need two teams. So we had to let some people go. But that, of course, also increases the profitability of the company. And yeah, doing those integrations is super important, but we saw in Q2 and Q3 that it also can be leading to short-term pains.
Mm-hmm. And then I thought we could talk about the revenue recognition change, and that is also something that was sort of frustrating for the investors because of the sudden change of it. So, and that came in Q3, and at the time, you were also mechanically sort of increased in the guidance as a result of that. And when you adjust these effects from the revenue recognition and also adjust for the M&A impact, it essentially meant that you were targeting the lower end of your previous revised guidance now in Q3 when you were changing the guidance, so to speak. And I know there are some accounting reasons for the change, obviously. But help investors to understand why were you making the revenue recognition in Q3 after a relatively soft quarter rather than waiting for Q4 or implementing it at the start of 2026, or even flag for this accounting change at the time of the profit warning when you likely had the visibility that it would be required to do this change?
Yeah, a very simple answer on that, Christopher. We didn't expect this. We had been discussing, and we were of the opinion that we didn't have to change the revenue recognition, and we had to. And we have, if we know those things, we have to communicate them. So we were not able to postpone it with the platform unification. The margin possibilities that we have with the volume that we migrated are much higher. We had a fixed margin setting in the old platform. In the new one, we have margin possibilities, and you saw that also already on gross margin, that our gross margin has been growing. And with that, our auditor was of the opinion that we had to change our revenue recognition. It has no effect on the EBITDA. It's a visual thing, of course, on the revenue, but we had to, and we were not, we were not informed, or we didn't know that we early about it. And we were also, didn't have a choice to do it later.
Okay. And you were talking about it, that the revenue recognition shade doesn't impact the EBITDA, but it does, however, impact the margins. So given that, will this change in your accounting prompt you to sort of update your profitability targets going forward? In terms of
it changes. It of course changes the margin indeed. If the revenue is higher with, let's say, the same EBITDA, then of course the EBITDA as a percentage of your revenue is lower. So that comes automatically with it. We will also, that investors can follow us, of course, be clear in communicating the numbers, and also communicate like-for-like numbers that people can see how that works.
And so sort of reflecting on the communication, and as mentioned, that has been some sort of some things that the investors have been thinking of, basically, and they are thinking that the platform issues weren't flagged earlier. The profit warning felt sudden. The revenue recognition change was sort of confusing. And when you reflect on 2025 as a whole, what is your assessment of the company communication this year, and will anything change going forward to sort of regain the trust from investors?
Yeah, we had 2025 was a difficult year for us, and a lot of things, especially the unification, didn't go as we wanted it to go, but also the revenue recognition was not foreseen. So, first of all, I can only apologize to investors because, I mean, it comes often as a surprise. We have to communicate those things when we know them, because to have full transparency, of course, to all investors. But 2025, I would call it, in hindsight, a year of transition where we really did a lot of changes, had to do some changes that we didn't expect, had some things that didn't go as well as we expected. But I would also like to emphasize we had to do it, and it makes the company only stronger. Apart from that, communication was maybe also not always as good as it should be. So we also took as an internal measure that we are investing in investor relations and also will in the future be trying to formulate things clearer and get better out towards investors than we did in this year.
All right, all right. And then we move to cash flow and the balance sheet. So investors are somewhat concerned about the weak free cash flow generation this year. And despite similar EBITDA level to last year, the cash conversion has been significantly lower this year. So what's driving this cash flow underperformance?
Thanks, Christopher, for this question, which we got from more investors. There are two effects that are, let's say, leading to this change. The one is that we did 30 million less securitization. Securitization is where we try to match accounts payable and accounts receivables. So we can go up to 100 million. We only drew 70 million, so that shows as a negative in the cash, but that we can change again, of course, and we are planning to change that again, that we go towards the 100 million again. So that cash is not gone, it was not showing in the quarter. Another thing is that in the cash flow, there was a booking for a payment of, the purchase for one of our acquisitions. That's roughly 20 million, and that 20 million should have been in the investment cash flow. So that also had a negative impact of 20 million. So if you take those two together, you see that the cash flow is not so different from before. And of course, let's say in Q4, you will see the effects turning.
And can you give us some sort of cash flow conversion targets as a percentage of EBITDA that you think is reasonable for Verve to achieve going forward?
Yeah, if you look at our cash flow of about 90 million currently, we have roughly 40 million of capex, roughly 35 million is interest, and roughly 15 million of taxes. So that gives the investor the possibility to calculate roughly where our free cash flow is, depending a bit, of course, on the revenue levels.
And then we talk about leverage. So investors note that you are above your target range of 1.5 to 2.5 net debt to EBITDA. And what is a realistic deleveraging path from here? And given that you are at 3x already, should investors be concerned about the financial flexibility or some sort of covenant risk in 2026 if the performance doesn't go as planned?
Yeah, the performance is going up and performance is getting better. So in that sense, we also stand to our target of getting towards a 2.5 times leverage. And we hope that we will show already quite a bit of that in Q4.
But can you give some sort of indication when you expect to reach the higher end of your target range?
No, we haven't given that to the market now. It would not be fair to all investors to do that in a single interview. But we will come up, of course, with our Q4 numbers.
Okay. And another question that I got from an investors was that given the current leverage, are you willing to finance a new potential acquisition through an equity raise if that would be needed?
There's nothing planned there. We grow organically and via acquisitions. We just did 2 acquisitions, and with those, we are busy of integrating those. So there's nothing planned at the moment. We can always tap a bond, and yeah, equity at the moment, looking at valuations, is not super attractive to use something like equity. So no plan there.
Okay, okay. And then I thought we could shift to M&A and sort of reflect on the track record that you have. And you've done several acquisitions in the past, with June Group being maybe the biggest acquisition in recent time. And obviously you acquired Captify and Acardo recently also. But how many of those acquisitions that you've done let's say in the past 5 years or so, has clearly been successful and delivered on the thesis that you had when you acquired the company versus companies that might be in some sort of underperforming mode?
Of the acquisitions that we have done in the last 5 years, that's basically, we started with doing edtech 6.5 years ago. It's almost all, or let's say it's all the edtech acquisitions, or with exception of a few, they all are good. Some better than others. A Dataseat that we acquired was an extremely good one. PubNative was a very good one. Smarter was a good one. So all the big ones were very good. Some smaller ones took us a bit longer to really bring them forward. But yeah, I'm super happy. We also had a slide in Capital Markets Day and also later in our Q3 presentation about what we have all been integrating, which is a lot of technology, a lot of teams. But yeah, overall, including the gaming acquisitions, we have less than 10% failures, which I think is very good for, let's say, doing M&A. And we're super happy with the value generation that we are doing. And June Group, you mentioned here, was indeed a very important one. Company that we acquired for very nice multiple, but was not growing. And seeing them now doing extremely well. And yeah, it's super nice to see that.
And if we flip the perspective and given the low absolute valuation multiples that Verve currently trades at, have you been approached by any potential buyers? And for what reason would Verve be an interesting M&A target for others?
Yeah, we have built a really good market position, and we on a regular basis get people that ask us if we would be willing to sell. Also, some investors are kind of indicating, why don't you look around? But at these kind of low multiples, it doesn't make any sense.
Okay. And then I thought we could shift towards the outlook. So we look forward a bit. And I thought we could start with the top-down perspective. So basically look at the market first. So do you believe that the 2026 market environment will be easier than 2025 based on your current outlook?
Yeah, I don't have a crystal ball, and that's in the current days very limiting, I have to say. It's so difficult, Christopher, at the moment to say what's coming up. Expectation is that 2026 will be better than 2025, but we still, I mean, majority of our revenues is in the US. US has uncertainty with tariffs, but yesterday we had the, let's say, reduction of the interest rate. So there's so many things influencing the market environment. 2025 was soft, but better than, let's say, a lot of people in the market had expected. 2026, we will see quite some extra elements coming in. There's football championships, for example. There's midterm elections. There's a president, of course, who wants to win the midterm elections. So I would expect 2026 to be a bit better than 2025, but it's super difficult to really do a reliable outlook there.
Yeah. And on the profitability, investors are eager to understand the path back to your historical profitability. And you're now guiding for 25 to 27% EBITDA margins for 2025, down from 30% in 2024. When do you realistically believe that margins will return to that plus 30 target range that you have? Is that a 2026 story or is it a 2027 story? And what are the key drivers that need to materialize to reach the 30% plus?
Yeah, if you historically look at the company, we have always been growing our EBITDA on midterm, and on short term, there's always, let's say, been some fluctuations. The Q2, Q3, of course, the unification doesn't do good, or actually it harms, of course, your EBITDA percentage. And as such, it's also not strange that our full year 2025 EBITDA percentage will be a bit lower. I'm talking about, let's say, the percentage versus the old revenue recognition. Of course, if you take the new revenue recognition into account, that number changes, like we discussed before. But I'm confident that taking on a like-for-like basis, that we will further improve our margins. And as mentioned before, now the revenue running very well on the platform, cost being further reduced, that of course makes a better margin. On the other hand, also to say that we are further investing in growth. We are further hiring sellers, people that sell our products. We have a great product portfolio. So of course, if you hire a seller, he doesn't or she doesn't immediately make the money. So that's also a bit of hurting your EBITDA. But overall, we will further grow our EBITDA. That's the target, and it also comes with the platform business.
And if you had to pick three KPIs that best demonstrate whether Verve is truly back on the right track, what would that be?
I think gross profit margin is a very important one because that's really showing the scaling effects. But apart from that, and we discussed that before, it's of course, the retention rate. A company that loses a lot of customers has much more difficulty to grow, and we don't lose a lot of customers, so that makes our growth speed good. And then adding new customers, of course, but also scaling those customers. So that's more than three, I know, sorry for that, but those are the important ones that we look at.
All right, gotcha.
Apart from a lot more smaller ones.
Yeah. So the next topic is competitive positioning and market dynamics. And I got the question about the competitive differentiation that Verve has. And you have talked a lot about Verve's proprietary data assets, first-party data from your own apps and SDKs. But how does this translate into tangible commercial advantage, and how does this show up in higher take rates, better CPMs, high win rates? Can you sort of quantify it?
It's a very good question, Christopher, and it would take a much longer answer, but I'll try to, let's say, go to the headlines. It's a big market. It's a growing market, advertising, but there's, of course, also a lot of players in the market. And you need, as a company, to also show that you're better in certain things than others. And we have chosen a few of those. The one is that we are really strong in-app. So we have a lot of apps where we connect it in, where we serve the ads. So we're one of the largest players in that. So if somebody wants to make or to reduce advertising into apps, we are one of the go-to partners. So that makes it already. But then on top of that, we're really good in also advertising in environments or part of in that in-app environment if there's no ID available. And as you see, let's say more and more, you see the question, especially on iPhones, do you want to be tracked? Majority of the people is saying no, the far majority of that. And so that's an environment. If you don't have this tracking link anymore, you need to do the whole targeting differently. And that's where we really have built a lot of technology to do that. And of course, publishers have more and more volume that doesn't have this ID. So they're eager to really sell that in a better way. And also advertisers don't reach a lot of people that always say no. So in that sense, we've really found a very nice pocket of the market, a big pocket of the market, because iPhone is 50% market share in the US. With an 80% no rate, basically, so no ID. So that's really giving us a very nice position there. But there's a lot of other things that we're working on, building on tooling, make it easier for advertisers to target. Now also with the Captify acquisition, we have a lot of extra data, intent data. What's the intent for somebody going to a certain page? So you can also use that for targeting. So there's a ton of things, but indeed, data and in combination with data AI are extremely important in this market. And that's areas where we're really further investing to become better. And we are good already.
But is it possible to somewhat quantify like the strength of your data assets? I mean, what if you had a very basic SSP? How would that sort of impact your margins? Is it like 100 basis points or 300 basis points, or is it possible to sort of
exact numbers
quantify the strength of the data assets?
Yeah. Sorry, Christopher, also a very good question, very difficult to answer because there's a lot of elements in that. What we show in our quarterly presentation is how much we grow our iOS, so our Apple in-app. That's showing that we outgrow the market faster and that we grow faster there than we grow in other elements. And also in-app without an ID is cheaper, has a lower CPM. So you also have the possibility to make more margin there. But we are, let's say, it's pretty complex and it's very different per market segment, per, I'd say, seasonality, there's differences. So in that sense, we don't have a single number that I could now give you.
All right, got it. And then we have hypothetical questions that investors are thinking about. And let's say if Apple or Google announced a major privacy change tomorrow, what portion of Verve's revenue would be immediately at risk, and what percentage still relies on identifier-based targeting versus truly ID-less solutions?
Very good question. How do I answer that? We would love it actually, because if there's a privacy change, it would mean that privacy gets more strict. There's hardly any expectation that they will loosen that in the sense, because the consumer also wants to be more privacy. More privacy means less identifiers, and less identifiers is really paying into our strategy. So in that sense, we would be super happy, and I would expect us to gain quite a bit of market share and to really grow our revenues strongly. And in extreme cases, we would even grow stronger.
Mhm. But do you have some sort of percentages on what share of your revenue that comes from pure ID-less solutions, and then other part that comes from that is based on identifier sort of based targeting solutions?
Yeah, let's say we publish those numbers, because if you look at our quarterly numbers, you see what the iOS share is. iOS share is majority-wise ID-less. And we also show that over 90% of our revenue is in-app. So in that sense, you see that it's a big part already, with a lot more potential to grow.
And then I thought we could shift to the European market positioning. So obviously you are very strong in the US, but what does your market positioning look like outside the US, and specifically in Europe? And also, what's the expansion plan in Europe? Is it aggressive growth, or will North America still remain at 70 to 80% of your revenue over the next few years?
Yeah, North America is now 75% roughly of our revenues. It has come down a bit because the other regions have been growing a bit faster than the US, but US remains our core market. It's the biggest market, the biggest advertising market overall, and also one that's really a united market where it's much easier to grow. But having said that, we also see that the strategy that we use in the US, where we really have strong demand and strong supply, really makes us getting a much better market position. So we're trying to build that more and more also outside of the US. The acquisition now, for example, in Germany with Arcado is paying into that, because then you have also a demand team, which makes it a lot easier to also sell your supply. Also makes more sense than to add local supply. The same in the UK with Captify. We also got a sales team in the UK. So all those things together, also make us think about doing more countries. But you need to do it on a per country basis. Just saying I do Europe or I do Asia or something is not working.
All right. And then I have some shorter questions. So we start with the status of the gaming business. So is that still profitable and worth maintaining for data synergies, or is it still, or more of a legacy drag at the moment?
No, the gaming business, we still like. It's a small part of our revenues now. I mean, advertising is by far the majority, 90% of the revenues. But gaming, we cut, let's say, smaller games a few years ago. Those were, let's say, the ones where you don't know if they're profitable. We have still some large games, amongst others, Extreme Car Drive Simulator, one of the top racing games in the App Store. So we're happy with them. It's not growing as fast as the advertising part, but it's growing. And we have a lot of synergies for testing, for example, our services, for showing ads. So there's a lot there. And looking at valuations in the gaming business, it doesn't make sense to sell it. I mean, at a certain point, we might do that. At the moment, we're super happy with it, even though it's not growing as fast as the advertising part.
Is it still profitable at this stage?
Yes, it is.
It is. All right. And then we have a question about your political advertising exposure. And obviously, we have the midterm elections next year. So how much of Verve's revenue is sort of tied to this political advertising, and how much of a boost should we expect in 2026 given the US midterm election?
Yeah, political advertising in the US is one of the, let's say, important advertising things. In, let's say, in the real election year, that's a very big budget. In a midterm election year, it's a lot smaller. Depends also a bit on the president and who are the people who are challenging that. So difficult to say how big the budgets will be. We assume that Mr. Trump will really fight for, let's say, having a lot of votes. So probably there will be good budgets. In 2025, it was roughly 10 million over Q2 and Q4 that we got on political advertising. So it's substantial budgets, but not the majority of our revenues.
All right, all right. And then a last question, and that's investors are quite curious how the advertising market has felt during the critical Black Friday and holiday period. So obviously you can't give me the Q4 numbers now, but directionally, are you seeing healthier advertising demand now, or is it have you noticed any strength or weaknesses in some of the different verticals that you're addressing?
Yeah, I need to be careful indeed how I answer your question here, because I cannot give you exact numbers, of course. But Black Friday and the important days around that, the Black Friday is actually a whole week now, and of course Cyber Monday, all those kind of things. We have seen really good advertising behavior, and as such, don't see anything that should make our investors worried about those days.
Okay. And then on closing terms here, I want to give you the floor to sort of close on your own terms. So if you could leave investors with one message, not about the strategy or market opportunity, but rather why they should maintain their conviction in Verve after this challenging year for you, what would that message be?
Yeah, it's not going to be one sentence, but I would indeed like, thanks for giving me the opportunity. If I look at Verve, we are one of the fastest growing companies in this space. And we do that in America, which is one of the most competitive markets for this. So we have really been able to build a very strong advertising business. The problem, if you grow so fast, and especially if you also partly grow via M&A, that it's not a straight line. And 2025 was a year of transition, which we underestimated, also to be very fair. We didn't expect the platform unification to be so painful. But if I see now where we are at the end of 2025, it's a very strong company with a lot of potential to further grow. We have a lot of differentiation. We have a very strong market position already. We have strong data, a very strong AI, and this company is there to further grow. And as mentioned before, we'll do further internationalization, and there's a lot of opportunities that we have. But we've really been able to build a lot of strong things, and I'm super proud about the team that we were able to get here, and I think we can get a lot further. I hope that answers your question.
It does, it does. Remco, thank you so much for joining me here today, and thank you all for tuning in and listening to this.
Thank you, Christopher.